Hello and welcome everyone. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com, and this is Trading Places Live. It is Monday, June 28th, 2021, and I'm pre-recording this Trading Places Live for Tuesday, June 29th. The futures currently are pointing to a negative open on Tuesday. Dow Jones futures down 25 points. S&P 500 futures down almost 5 points, and the NASDAQ getting hit a little bit harder, down about 27.5 points. We're going to get into action in just a minute, but let me first walk you through the agenda for today. We're going to start off with the daily market recap. Then we'll get into talking technically. I want to go through some of the cruise lines, which had a rough day on Monday. Then we'll get into market rotation, warning shots, earnings spotlight, and we'll wrap up as we always do with the 3 you must see. Before we get into any of that, let me walk you over to earningsbeats.com, to our website. On the left-hand side, you can see we have a subscription form to sign up for our free Earnings Beats Digest newsletter. This is a newsletter that's published 3 times a week, Mondays, Wednesdays, and Fridays. It is free, no credit card required, and you can unsubscribe at any time. Simply type in your name and email address in the boxes provided there, hit that subscribe button, and we'll make sure we get you all set up. Taking a look at the action on Monday, the Dow Jones Industrial Average lost 150 points. It was a bifurcated session, though. The S&P 500 actually was up 10 points, and the NASDAQ, on a relative basis, did very well, rising 140 points, or almost 1 full percentage point. Mid caps, however, lost 1%. Small caps were down 1% as well. So definitely there was a lot of rotation taking place in the market today that favored the growth stocks, favored technology, also favored communication services, which was the best performing sector on the day. Communication services up a little over 1%. Technology also up just a little over 1%. Taking a little bit of a hit, though, was energy. Crude oil prices were down on Monday. We haven't seen that very often, at least not recently. And energy, as a result, took a little bit of a hit, down about 3 1/3%, falling back below the 20-day moving average, as you can see here. Although I do think it still remains in this uptrend, I would be more concerned if we were to fall back and lose about $51 to the downside. We still have some room there. Moving on to the industry groups, renewable energy up about 6.5%, so continuing its run. Last 5 or 6 days have been very strong, moving off the moving averages, breaking out to new highs. I thought taking out the 240 level was a pretty big deal, and we did that with some gusto on Monday. So renewable energy looking very strong in the near term. Recreational services, the worst performing industry group. As I mentioned, many of the cruise lines struggled after Carnival Cruise Lines reported earnings that did not meet expectations. And as a result, we saw the whole group fall. We had moved below the 20-day, but we were really just kind of squeezing between the 20-day and the 50-day moving average. But we clearly lost both on the close Monday, and volume accelerated as well. So not a good combination, breaking down to the downside with increasing volume. The 10-year Treasury yield, you can see, did fall slightly on, actually a little bit more than slightly. We fell about 6 basis points to 1.48%. After closing at about 1.54% on Friday of last week. We had closed back above that 20-day moving average, but today we moved back down, closed beneath it. I think we still remain in a short-term range from about 1.40% up to maybe about 1.60%. We'll see which way we break. I would suspect we'll eventually break to the upside, but I do think we need to remain with an open mind there. Financials struggling today on a relative basis. That typically happens when we see the 10-year Treasury yield struggle. That's what we saw again on Monday. Financials weak. Also, industrials really have been weak as well during the month of June. All right, moving on to talking technically, I wanted to take a look at the recreational services index. What I'm seeing here now, that move in June, which looked like we were having a breakout above prior highs, was maybe a little bit suspicious simply because there wasn't a whole lot of volume to support that move to the upside. Since then, we've not only lost the breakout level, but we also failed to hold the rising 20-day EMA. A lot of times when you have a false breakout and you pull back and fail to hold the price breakout level, you'll move down and you'll bounce off the 20-day moving average. We did neither. And you can see now we're struggling to get back through the 20. And then on Monday, big day to the downside on recreational services. You can see that volume bar really pick up. So I think we're probably headed back to test these recent lows. And this is going to be a big support level if we do get back down there, because this was the breakout with volume that we saw back at the end of February. So you can see the big volume increase, the huge move through the December high. And since then, we've gone back down and tested this area twice and held successfully. So if we do go back down, which it looks like we probably are, big question for me is, can we hold 98 on a closing basis? And if not, then I think we could be in for a lot more trouble. So let's take a look at some of the individual stocks. So Carnival reported earnings, and the loss was much higher than expected. That did not serve the stock well on Monday. You can see volume shot up to about 64 million shares. This was the highest volume that the stock saw for about the last, dating back to the first week of April. So it's been almost 3 months since we've seen this kind of volume. And just like the overall index, I think the big question is going to be, can we hold price support? Back in December, that high was 24. We came back down. We tested 24 in March, got close again in mid-May. So $24 seems to be the level where it looks like Carnival will move back to. And then the question becomes, do we hold it? Eventually, we want to get back up through these moving averages. We've been struggling there over the past 2 weeks. So I think we're bound right now, downside $24, upside the 20-day moving average. All right, let's take a look also at Royal Caribbean, RCL. RCL pulled back very similar fashion below the moving averages, came back up, really failed to sustain that move. We did close on Friday just above the 20-day, but we quickly gave it back today, breaking back to a new closing low over the last 4 weeks or so. Volume picked up on this stock as well. And I would say that the recent low in mid-May, down just below $80, certainly looks like it'll probably be challenged. Then we've got Norwegian Cruise Lines. And similar story here. You've got the equal highs coming in right around $34. The recent lows, 25 to 26 support. Closed back below the moving averages, closing down close to 29 today. I do see 25, 26 perhaps as the target here on NCLH. So again, cruise lines just really struggled here today. I think they've been struggling for the last few weeks, and now starting to confirm what I believe are more important breakdowns on the daily chart. So you want to be careful with this group. All right, moving on to market rotation. Recently, I've talked about the dollar, which has strengthened, and that has put some pressure on material stocks. Materials, as you can see, we had this triple top with each one of these highs. You can see that PPO had rolled over, so momentum seemed to be waning. And then we fell apart mid-June, so maybe about 2 weeks ago, losing both the 20-day moving average, the 50-day moving average. And what I really don't like, there are two things here on this chart. Number one, if you look in June, I only see 2 hollow candles. Just about everything else is a filled candle, meaning that this is an area of the market that keeps closing below its open. So it's just a sign of distribution. That volume in mid-June on the heavier selling, I think also reeks of distribution. So those two things are certainly things to be worried about from a trading standpoint anyway with materials. But this latest bounce here over the past week or so just seems very weak. We haven't been able to get up to the 20-day EMA, which is crossed below the 50. So we have that death cross. The PPO is now in negative territory. So momentum is really picking up to the downside. I believe we're going to continue to go lower in materials. So I would be very careful with materials. Now, if we do pull up the weekly chart, gives maybe just a little bit more hope in that we are bouncing or trying to bounce off the 20-week moving average. And if you look back over the last year or so, that's been a great area for entry. But I think part of what's been driving materials to the upside is a very weak dollar, and I'm beginning to see signs of that changing. And if that continues to change and the dollar strengthens, I do believe materials are going to be unsuccessful on this test of the 20-week moving average. So just a few things there to think about. Now, if we move on to some individual stocks within the materials, some of these signs, if you will, don't look very promising to me. I'm going to pull up NUE, but I want to do it on a different chart here. Take a look at the last high back in early June, and then look at that PPO. That's a very nasty negative divergence. And normally what I would expect when you're going up in the momentum, with PPO rising, normally when you go through periods of weakness, you'll bounce off of that 20-day EMA, and that's what we had done for a few months. But when we saw that negative divergence really kick in, you can see we didn't bounce off the 20. We went down to the 50. We reset the PPO back at the center line. That is normally an area where you can kind of reassess and see whether or not the stock is going to gain support, bounce, or are we truly turning from a more bullish picture to a more bearish picture? It seems to me the latter. I don't like this heavy volume coming in on the selling. I don't like that failure at the 20-day, nor do I like that reversing candle, that bearish engulfing candle right at the 20-day moving average. So PPOs turn negative. It just seems like momentum now is to the downside with many of these material stocks. Nucor certainly is no exception based on what I'm seeing here. Then we got Freeport McMoran. FCX, this is one of the hottest stocks over the last year, but this too seems to be running out of gas to the upside, rolled over, lost the moving averages, went back up, tested them. Look at the volume trends turning negative. I think you got to be really careful with FCX at this point. Next up is International Paper IP. Similar, moving up, higher prices, lower PPO, negative divergence. Now we've been trending below the 20-day moving average. If we go back down and break down below the 58.5 area, I think that would be an additional bearish confirmation on IP. CF, this is CF Industries Holdings. Once again, triple top, lower PPO, coming down on increasing volume, failing to hold the 20-day, 50-day. We go back up, we test both, and then roll back over again on increasing volume. Be careful. This one, I would say you've got some pretty decent support at about 48.5. If we fail to hold that, I would expect more selling ahead. MOS, this is one of our portfolio stocks. I think you got to be very careful here. As a trader, I would be out of the stock. Our portfolio stocks, we hold them for a full 90 days just to be transparent. Very easy to calculate our gains and so forth, or losses. But Mosaic does not look nearly as good now as it did back when we selected it in May when our portfolios were selected. So you just want to be careful. I think if you are in the portfolios and you're interested in stops, I would think the recent low, really a close much below 29.50, 29.75, I think goes back to about a 4-month low. And based on what we're seeing in the rotation and all, I'd be very careful with not just Mosaic, but all of these material names I'm going over. Next up, PPG Industries. We had gapped up, and on that gap up, you can see that we pulled back and the buyers came back in at 165. See the heavy volume coming up here. We gapped up to about 168, 169, ran up into the 170s, and we pulled back. We didn't fill the gap. The buyers came back in at 165 and drove the stock back up over 180. Now here on this pullback, notice the low on Monday was 165.51, testing this side. I'd be careful if the stock closes below 165. WRK. This is WestRock. You can kind of see similarities in all these stocks. No negative divergence here, but we did move below the moving averages. Really have had a very minor bounce attempt here. PPO continues to look weak. I just think if you can't hold these recent lows, then you're starting to see a pattern of lower lows and lower highs. And that is, or those are the hallmarks of a downtrend beginning. So we want to be careful. EMN, this is Eastman Chemical. Same thing, double top here, failure to hold the price support level, trending below the moving averages, PPOs turn negative. just doesn't look good. And the last one I have for you here is Alcoa. This is AA. Put that top in on May the 10th, put in a lower low, lower high, and then another lower low. On Friday, we had a bearish engulfing candle, and look at the volume coming in on that reversing candle. And then on Monday, we did bounce a little bit, but we're staying below that 50-day, and it just looks like it's starting to roll back over again. So be careful, especially if Alcoa were to go back down and lose that 32 support level. All right, next segment I wanted to go through is warning shots. So here it looks like some warning shots have been fired in a few different industry groups, so I thought I would bring these up. The first is the Dow Jones US Asset Managers Index, and you can see we're pausing right where we got to back in the middle part of June. We had gotten up to about the 288 level, fell back to 273, and then over the course of the next week, we worked our way all the way back up to this 288 level, pulled back, so far holding that rising 20-hour EMA, which is good news. But the problem is if we get through this 288, 289 area, you can go back here over the last month or so and you can see some pretty good resistance up closer to 290. And watch this hourly PPO, because if we do bounce back up to a new high, chances are we're going to see a negative divergence. So even if AG hasn't topped yet, I think getting back up close to that 290 level, you're going to want to be careful, at least in the short term. Now, if AG can get through the asset managers group, if it can get through 290 and sustain that move, obviously that's very bullish, but I just wouldn't assume that's going to happen. Instead, I'd just follow the chart, follow these signals, and I would be willing to take profits if I was in this group and move to the sidelines and see whether or not it can make the breakout. Another area, and this is in technology, that has a similar looking chart, and that is electronic equipment. Now the PPO doesn't look quite as bad. It's down a little bit. We do have a slight negative divergence, but you can see this price resistance area is obviously something we need to at least recognize. 1,022 to 1,022.50. That's where we stopped back on June 16th. To the upside, that's when we saw some selling coming in over the next couple of days. And now here we've rallied all the way back up, gotten all of that back, and now we're back to the 1,022.50 area again with a negative divergence. Now again, it's not that negative. If we have a strong day, get a breakout, I think you could see that divergence eliminated, the negative divergence. But at least in the near term, it's looking just a little bit suspicious here. Two other charts, and I'm going to move away from the hourly chart now. I want to talk about the relative strength chart for two different industry groups within materials. And I think you're going to see that they've deteriorated quite a bit. First is containers and packaging. Now, this is a relative strength chart that we include in our industry group relative strength chart list. So we have 104 industry groups in this chart list, and they're all reflected on a relative basis to the S&P 500. So we've got to be a little careful here with containers and packaging, because if you look at the last month and a half, the relative strength has really fallen apart. We had this double top, relative double top, and now we've come back down and we've taken out this intermediate or this middle low, which I think does not bode very well for this particular area. Now we're at a relative low that we haven't seen. We haven't been at this relative level since all the way back probably in August or early September of 2020. So containers and packaging have definitely moved down. Now, when you look at their absolute chart, and this is the difference between absolute and relative strength, absolute chart still looks pretty good. And maybe this is just some consolidation in the near term. But usually when you're consolidating, you don't move to a 10-month relative low. And so this has been pretty significant here. Some of the relative performance, the weakness has been pretty significant and taking it to new lows. So I think we just have to be very careful here with this containers and packaging group. And then another one within the materials area is the DJUSRQ, which is your specialty chemicals index. And like the last one I just showed you, containers and packaging, you can see this one also breaking down to many month low, relative low. This was back in November. So all of the gains that we saw after that positive vaccine news came out back in November had the huge move up here to new highs. We've lost all of that relative strength and we're back to where we were in November. Now, on a, again, absolute basis, we're trending higher, but the idea is to outperform the S&P 500. I mean, if the S&P 500 goes up 20% and you're in an area that goes up 15%, yeah, you made 15%, but you lost 5% versus the benchmark. And so that's the difference when you look at these charts. One's telling you that you're going higher overall, even though we have gone down the last 45 days or so. But we're still going higher on the chart. We're still in an uptrend, but we've lost a lot of relative strength. And so if you're trying to outperform the S&P 500, specialty chemicals probably not a great area to do so. All right, let's move on to earnings spotlight. Not a whole lot on Monday, other than the Carnival Cruise Lines, which I talked about earlier. We don't have a lot of earnings out later this week, but I thought I'd go over a few companies that we'll be reporting. So tomorrow, Tuesday, we do have FactSet Research Systems that we'll be reporting. I don't like the way this chart's setting up heading into earnings, so I'm not expecting a huge number or a very good reaction from Wall Street. But we'll see. I mean, sometimes these patterns will change based on earnings as new data comes out. But Wall Street is not impressed as we head into earnings. And if they're not impressed, I'm not going to be impressed. You can see outside of one day back in April where we had a really nice move up, that was probably earnings related. You can see outside of that, this has just been a stock that relative to its publishing peers has not been a very good performer at all. So I would be very careful with FDS heading into earnings. This is not the kind of stock that I would be interested in holding into earnings. Now, a much smaller company, FDS, I think, is about a $12 billion company. Here's one that's under $1 billion. This is Ammo Inc., ticker symbol POWW. And the reason I mention this is we keep a raised guidance chart list, and POWW has raised their guidance. I think I want to say like 3 or 4 times in the last quarter or so. Maybe it goes back a little bit further than that. But this is a company that has been giving some pretty good vibes about its upcoming earnings report. It had a reversing candle on Monday and pulled back. And if Tuesday it's down a little bit, might be an opportunity for those of you that are, if you don't mind taking on more risk, because I do think these smaller companies can really move with their earnings. But it's similar to a stock that I talked about last week. I had put out a stock, Jinko Solar, to our members before earnings went out. And I said, you know what? Renewable energy has been strengthening. And we had I think it was Plug that came out recently, reported numbers. They fell short of Wall Street expectations and the stock gapped up big time anyway. So it was beginning to paint this picture that all the bad news was priced into renewable energies. And if you look at Jinko Solar, I mean, this stock, since they reported earnings, just absolutely exploded. So it was trading at about 37 or 38 when I put it in our daily market report on Thursday of last week. And the stock had 2 huge days after earnings. So it's gone up probably 40% in just the last 2 days after earnings were reported. Now, obviously, you never know for sure you're going to see any kind of reaction like that on any stock. But what I will say is that Wall Street, I think, is impressed with this stock. While you look at the last 3 or 4 months, you say, well, it really hasn't gone anywhere. Well, it's consolidated. The stock was down at $2 in November, and it went to $10 in February. So in 3 months, the stock was a 5-bagger. That's a lot of move to the upside. You got to give these stocks time to consolidate. And in fact, they may come out with good earnings and they may continue to consolidate. But I do think they're going to have good earnings. And with those earnings, we'll have to see what the market reaction is. But if we can get through $10, I think POWW could make another run. And the further you go down before earnings, I think the better the reward to risk is of being long. Although again, anytime you hold a stock into earnings, you got to be willing to take on quite a bit of risk. Later this week, we will be getting Micron, Constellation Brands, General Mills, Bed Bath & Beyond will be out on Wednesday. And then Thursday, we've got McCormick and Walgreens, Boots Alliance, Acuity. And I think that's probably about it of the larger companies. But so we do have some companies coming out later this week, but the big one I would say is going to be Micron out on Wednesday. That's in that semiconductor space. So we'll see what kind of reaction we get there. All right, let's move on to our final segment, which is 3 you must see. The first stock I want to show you is Costco. I'm going to stick with 3 retailers. First of which is Costco. You can see the top that Costco put in back at the beginning of December. We've come up here into this 380, 390 area, which is where we were in December. We've done that and stayed there for about 7 weeks, trying to get through 390, couldn't do it. And here in the last week, we finally have broken through. I'd like to see a little bit more volume. It's not awful, but it's just not confirming. It's not the kind of volume I would like to see after a lengthy period of consolidation on a breakout, but it's still, pretty solid. So Costco, I think looks good. I would prefer it at this point on a pullback, maybe to the breakout level down near that 20-day EMA. Second stock, Target. Target, I think, looks very strong. It's been one of the better performers in this space. The AD line, which had suffered all the way back into early March, has really come back strongly. So I think there's accumulation taking place. Very, very few filled candles, red filled candles. Mostly we just keep moving higher in Target. And if you look at the stock relative to its broadline retail peers, it is right near a 52-week high. So it continues to perform well. The last one, you may have heard this company, Amazon. Amazon, the AD line is a little worrisome, but I do think we're starting to strengthen. I like these candles here in June, volume picking up. I believe we're going to hold this 20-day moving average, and I think the next move is going to be to the upside, and I think it's going to be a breakout, and I would look for some increasing volume on that breakout. We have been going sideways for almost a year. So if we do break out, I expect a big move to the upside in Amazon. So I do like this one. All right, that is it for me for today. Appreciate everyone tuning in. I'll be back on Wednesday over at earningsbeats.com for the next episode of Trading Places Live. That will begin at 9 a.m. Eastern. Everybody have a great Tuesday. Hopefully see you on Wednesday morning. Happy trading.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.